Now that you have answered those important questions, it is time to decide on the concept you want to trade. Few people trading the markets have a system to guide their trading or investing. Of those that do, most are just using predefined indicators. Very few people understand the concept behind their system. Your goal in this segment should be to think about each concept and determine if any of them fits your personality. The concept that fits will be the one you have the most success trading. The following are the most common trading concepts. It is from these concepts that trading strategies are derived. As we discuss each of these, keep in mind those that best fit your personality and temperament. The investor must realize that if he or she can get on board a major move, the profits from just one trade can be substantial. In essence, one trade can make your whole year. Thus, the reliability of one's strategy can be far below 50% and you'll still show a profit. This is because the average size of one's winning trades is so much greater than the size of one's losing trades. Trend followers often get whipsawed, as trend following signals immediately turn against them, causing small losses to occur. Multiple whipsaws can add up, creating concern for the trend follower, and tempting him or her to abandon the strategy. This is as example of a simple trend following strategy, moving average crossovers. Notice that when the faster moving average in red crosses over the slower moving average in blue, the market is trending upwards. However, there will be instances where the moving averages cross over multiple times, what we call whipsaws, and you will suffer losing trades as a result of false signals. Traders often use more than one indicator to seek confirmation and avoid whipsaws as much as possible. Value trading is one of the major methods used by portfolio managers. You can liken this to fundamental investing, the key difference being that technical indicators, such as momentum, are taken into account before buying the undervalued asset. An extreme form of value trading is finding stocks that are selling at a substantial discount to their liquidation value. And for such undervalued stocks, value traders never buy when the stock is going down. Just because it is undervalued today, does not mean it cannot be more undervalued in the next few months. Next, band trading is based on the belief that the market moves much like a rubber band or a spring, stretching from a certain point and then pulling back. Traders sell when price hits the upper band, and enter long when price hits the lower band. As with all things, there are strengths and weaknesses to band trading. Band trading is effective in many more market conditions, as compared to trend-following strategies. It works in up, down, and sideways markets, as long as there is enough volatility to produce a ranging band. This allows for more opportunities to trade, and a smoother equity curve. As for weaknesses, band trading is counter-trend in that you sell after a move up, and enter long after a move down. This can be challenging for the human psychology. Band trading also does not work in strongly trending markets. With the rise of globalization and international trade, the various asset classes are interlinked and related. Some traders use relationships between and within markets to form decisions about the price direction of a particular asset class. This is one concept of trading. For example, in this blue table, we give an example of how stocks, bonds, currencies, and commodities interact. The currency markets have an impact on all markets, but the main one to focus on is commodity prices. The US dollar and commodity prices generally trend in opposite directions. As the dollar declines relative to other currencies, commodity prices, which are based in US dollars, generally increase. As commodity prices rise, the cost of goods is pushed up. This increasing price action is inflationary, and interest rates also rise to reflect the inflation. Since the relationship between interest rates and bond prices is inverse, bond prices fall as interest rates rise. As borrowing becomes more expensive, and the cost of doing business rises due to inflation, it is reasonable to assume that companies and stocks will not do as well. Bond prices and stocks are generally correlated. When bond prices begin to fall, stocks will eventually follow suit and head down as well. The converse is also true. You often hear investment professionals forecasting price direction of one asset class, based on the price action of another asset class. Next, we consider channel breakouts. One example used by the famous turtle traders is called the Donchian channel, which is a trend-following breakout system. As you can see, an upper and lower line is drawn, creating a channel. Whenever price broke out of this channel, traders would enter a trade in the direction of the breakout. The last trading concept we will discuss is trading based on patterns. This is an example of a triangle pattern, which traders look out for. We see that two connecting lines are joined, along the highest highs and lowest lows, forming a triangle pattern. A breakout above or below the triangle is expected to carry price in the direction of the breakout. You can learn all about chart patterns in the other e-learning modules offered by APF Trading. Japanese candlesticks is another example of common patterns which traders use. Over here, we see the inverted hammer pattern in green, which is a sign of a price reversal. In this chart, if you were waiting for a chance to buy, you will be alerted once you notice an inverted hammer pattern. To learn the complete range of candlestick patterns, you can watch APF Trading's Japanese candlestick module. Now that you understand how to determine concepts you want to trade, let's move on to numerous other topics from AsiaPacFinance.com.